A wealthy family in the United States keeps most of their money in stocks. A wealthy family in Germany barely touches the stock market at all. A wealthy family in China has a huge chunk of their net worth sitting in real estate. Same goal, get rich and stay rich. Completely different playbook. Today we're breaking down how the wealthy actually build their money in 6 different countries, and why copying the wrong playbook for your country could be holding you back. Welcome back to Rich Circle. Let's start in the United States. Meet Marshall. He's a fairly typical wealthy American. Not a billionaire, just comfortably rich. The majority of his net worth sits in the stock market, through his retirement accounts and a regular brokerage account. He barely thinks about it day to day. Every paycheck, a chunk goes automatically into index funds, and he lets decades of market growth do the heavy lifting. This works in the US for a specific reason. The stock market has strong legal protections for shareholders, tax-advantaged retirement accounts are widely available and heavily used, and there's a deep cultural trust in owning a piece of companies as the default path to wealth. Real estate matters too. Marshall owns his home, but for the truly wealthy in America, stocks are usually the dominant asset, not property. Now, let's go to Germany, where the picture looks almost backwards. Meet Ingrid. She's wealthy, but unlike Marshall, she doesn't own her home, and she's not unusual for it. Germany has one of the lowest homeownership rates among wealthy countries, even among rich households, because renting is culturally normal and tenant protections are strong, making renting a stable long-term choice rather than a step people rush to escape. Instead, a lot of German wealth is built through stable, conservative channels, solid pension systems, cautious investing, and for business owners, ownership stakes in the middle stand, the network of small and mid-sized family businesses that make up a huge share of the German economy. Ingrid's wealth isn't sitting in flashy stock picks. It's sitting in decades of ownership in a business, plus steady, unglamorous savings habits. Now to China, where property is king. Meet Wei. A huge portion of his net worth sits in real estate. Not just his home, but multiple properties. For years, real estate in China was viewed as one of the only reliably appreciating assets available to regular households, especially compared to a stock market seen as more volatile and less accessible. Property became the default store of wealth for an entire generation of newly wealthy families. This created something economists call intense housing wealth concentration, a huge share of household net worth tied up in property values. It's worked well during periods of rising prices, but it also means Wei's wealth is far more exposed to swings in the property market than Marshall's stock-heavy portfolio or Ingrid's business and pension mix. Now to Japan, home to one of the most cautious wealth-building cultures on the list. Meet Haruto. Even among wealthy Japanese households, a strikingly large share of assets sits in plain cash and bank deposits, far higher than in the US or most of Europe. This traces back partly to decades of deflation and stagnant markets following Japan's economic bubble in the early 1990s, which taught a generation that markets could disappoint for a very long time. Trust shifted toward cash, savings, and stability over growth. Haruto isn't chasing high returns. He's optimizing for certainty. In a country where prices have historically barely moved and a saved yen keeps roughly the value it started with. It's a completely different bet than the one Marshall is making in the U.S. stock market, but it's made rational sense given Japan's specific economic history. Now to India, where wealth often takes a shape that looks unusual to Western eyes, gold. Meet Priyanka. A meaningful slice of her family's wealth isn't sitting in a bank account or a brokerage account. It's sitting in physical gold, jewelry, and land. India is one of the largest gold-consuming countries in the world, and for generations, gold has functioned as a trusted store of value that survives currency devaluation, doesn't require trust in a bank or a stock exchange, and can be physically passed down between generations at weddings and family milestones. Land ownership plays a similar role. Owning a plot of land, even undeveloped, is widely viewed as one of the safest long-term stores of wealth, especially outside major financial hubs, where stock market participation has historically been lower. Priyanka's wealth strategy leans on two things you can literally hold and hand to your children: gold and land, rather than a number on a brokerage app. It's a playbook built for trust and portability in a country where formal financial market participation has grown quickly, but tangible assets still carry deep cultural weight. Now let's look at Nigeria, where wealth building looks different again. Meet Adiz. Her wealth is built primarily through direct business ownership. She runs and owns a company outright, rather than owning small slices of many companies through a stock market. In many emerging economies, public stock markets are smaller, less liquid, and less trusted than in the US, so building wealth often means owning something directly and completely: a business, land, or property, rather than shares in someone else's company. This playbook demands more hands-on involvement than Marshall's largely passive index fund strategy, but it also means Adiz has direct control over her largest asset, in a way none of the households we've looked at so far really do. Line all six up, and the pattern isn't random. Each playbook exists because of the specific rules, history, and trust systems of that country. Americans lean on stocks because the market is liquid, well-regulated, and tax-advantaged accounts make it easy. Germans lean on renting and business ownership because tenant protections are strong and public markets are less central to everyday financial culture. The Chinese leaned on real estate because it was, for decades, one of the few assets reliably available and trusted at scale. The Japanese lean on cash because their market history taught extreme caution. Indians lean on gold and land because those assets are portable, tangible, and trusted across generations, independent of any single financial institution. Nigerians lean on direct business ownership because public markets are smaller and control matters more when institutions are less predictable. Fair pushback here. Doesn't this mean one country's approach is objectively better than the others? Not necessarily. Each playbook is a rational response to the specific system it exists inside. Marshall's stock-heavy approach would be far riskier in a country with weak shareholder protections. Wei's real estate-heavy approach would be far riskier in a country where property values aren't reliably trending upward. Priyanka's gold-heavy approach would look overly conservative in a country with a deep, trusted stock market, but makes complete sense where physical, portable trust matters more. The best strategy is the one that matches the actual rules of the system you're operating in, not whichever approach sounds most sophisticated from the outside. Here's the twist worth sitting with. None of these six people are doing something wrong. They're all responding rationally to the incentives, protections, and history unique to where they live. The mistake would be blindly copying Marshall's U.S. stock-heavy strategy while living somewhere with a completely different set of financial rules, tax advantages, and market history, or assuming Wei's real estate-heavy approach, or Priyanka's gold-heavy approach, translates cleanly to a market where those assets don't behave the same way. The common thread underneath all six, though, is this. Every one of them found the most trusted, most protected, most liquid asset class available in their specific country and concentrated their wealth building there over decades, not years. The vehicle changes by country. The patience and consistency behind it doesn't. So the real question isn't which country's rich people have it figured out. It's what's the most trusted, protected wealth-building tool available where I actually live, and am I using it consistently? That answer looks different in Ohio than it does in Berlin, Shanghai, Tokyo, Mumbai, or Lagos. And that's exactly the point. If this gave you a new way to think about building wealth in your own country, subscribe to Rich Circle.